Macquarie launched its High Conviction Fund in 2005, and since then it's been a turbulent ride for investors. Today I have the head of the fund, Mark Harrison, here with me. Thanks for joining me today, Mark.
Thank you.
Mark, what's your broad investment strategy?
Julie, there's probably three things that we think of when we think about our investment strategy. And the first and the most important thing is we actually think markets are too short-term focused. So what we do with our fund is we look through the short term. So we look to a 3-year horizon. We think that's the right balance between getting through the short term, but also actually being able to forecast realistically. So we think of that as the end point. We worry about the end point for these shares. The other thing we do that's very important is we worry about the journey there. So what we don't want to do is buy stocks that look cheap on a 3-year basis, but we think are going to have a material earnings miss along the way. So the core of our investment strategy is worrying about the end and the journey. The second thing we do is when we do our research, we focus on the things that matter. We feel that too many people worry about everything that's going on and forget to spend their time really worrying about the things that are important about a stock. The third thing we do with our investments is we worry about the risks that we're taking. It's very important that we understand the risks. It's not that we don't take them, we just don't want to take unintended risks.
How many stocks do you hold in a concentrated portfolio at any one time?
Yeah, typical of a concentrated manager, we're around 25 to 30 stocks.
What have been the best and worst calls in the fund's history?
I actually talk about just one stock on this one because it illustrates how we think, and that was Rio Tinto. It was our best contributor in 2008 financial year, and it was our worst contributor in 2009. Rio was a stock which, the thing that matters about Rio is iron ore. And we'd done a lot of work when we got into the stock on the iron ore market. And we felt that the market at the time was seriously underestimating the prices that were going to come out of iron ore over the next 2 to 3 years. So we felt, because of the importance of China to the global steel market, that the growth in China was sustainable, that people were going to get some upside surprise. And that's what ended up happening. There was some material surprise to the iron ore price negotiations 2 years ago, and then along came the BHP bid. And so we had Rio as one of our core positions. Then, of course, the world changed. And what we had done is we were, in July of last year, we still held a very strong position in Rio. But we were conscious that China was slowing. And it was slowing because of the Olympics. They were shutting a lot of things down. And probably the mistake we made was knowing that things were going to slow in China on a very short-term basis. We decided we'd ride through that. And, people got nervous about China and the stock started selling off. What really impacted us, of course, was the collapse of Lehman's, when China's theoretical, mild short-term slowing became a real shock as global supply. Global demand for steel, global demand for anything collapsed. And so we got what we thought was going to be a short-term problem emerged into a medium-term to long-term problem. So Rio kind of turned from our best call into our worst call during the financial crisis. We exited the stock quickly and have subsequently re-entered it after Chinalco kind of came along.
How often do you change the investments within the fund?
Look, as we try to invest on a 3-year horizon, and so if that turns out to be an average hold period of about 1.5 to 2 years. So we think about the expected turnover in the fund to be around 50 to 60%. It has been running higher than that, initially because we're doing, performance was very strong, and the last year it's just because volatility's been very dramatic, so we've had to turn stocks a little bit faster than we'd like to.
What type of investors are attracted to a high conviction fund?
I think the most important thing that investors in any equities product should be is long term. And particularly for a concentrated product, they are higher risk, they are higher return. If you are a short-term investor, if you just worry about what's the stocks and what the market's doing month to month, you shouldn't be in a concentrated product because there is going to be volatility. So it's long-term investors that align their thinking to ours. We're a long-term investor.
You've been criticised for the expensive nature of this fund. How do you justify that cost to investors?
Look, the fund is expensive, and we think you pay for what you get. Our returns after fees have been over 5% per annum above the benchmark, and that's an after-fee number since inception. And over the last 3 years, the returns after all fees have been over 4% above the benchmark. And so these are what we aspire to do with this fund, and it's concentrated. It is higher risk, but it is higher return.
For investors looking at a fund such as yours, what's the suggested allocated weighting that you might give it from their portfolio?
We'd love them to do 100%, but actually we never advise people to put 100% of their funds into any one product. What we think is that people should be using a combination of lower risk and higher risk products, and we think that people should be using somewhere around 30 to 50% into higher risk products. And again, they should be diversified in some of their higher risk products. So again, we wouldn't say, invest half your money into a concentrated manager and invest it all with us. There should be a little bit of diversification going on there as well.
What's your most significant holding at the moment?
What we like actually at the moment, we like some of the domestic exposures. We are concerned about slow global growth persisting for a long period of time, and we do believe Australia is better positioned than the global economy for growth. But again, it's going to be slow. What that's leading us to do is look, what are domestic exposed stocks that aren't going to have big downside surprises over the next 2 to 3 years. So actually some of the banks are our bigger positions. We like CBA, we like Westpac. But we have selective global growth exposures. We like News Corp, we think it's too cheap. We like Incitec because we think actually people are too focused on the short term again with that stock. And we still like Rio. We still believe that same thematics that we talked about 2 years ago are still right. The iron ore market is going to continue to surprise people on the upside.
Thanks for your time today, Mark.
Thank you.